Hello, trading world. Here we are this evening. I was asked to do a post-facto analysis on today's trading. So I hope this helps and gives you some insight on how to use the trading outlook or pre-market outlook, and helps you in identifying certain things that are helpful in trading. Alright, I'm going to try to keep this video simple and just stick to the basics, so I won't be going too deep into indicators. One, because I'm not sure of what you were looking at to lead you in the direction you went, and two, indicators can take us down a deep rabbit hole because the interpretation of many indicators can be more art than science. So for the purpose of this video, we're going to focus on four things. One, volume. The second item, the indicator that we're going to use for the time being is going to be the MACD. The MACD is pretty much universal, something that most traders use or understand. Three, convergence and divergence. This is kind of the hallmark for most technical trading. So understanding these principles are a must. And four, I'm going to do a small touch on the mental focus of a trader. And as you can see, the last two things are by far the most important. Finding technical clues, identifying patterns, that is the easy part of trading. The hard part is the mental side and understanding how to put these concepts together and not just have it look like illusions on a chart to you. Alright, so I'm going to ready the chart. We're going to just focus on volume and the MACD. So give me just a second to center those things on the chart. Alright, now that we got the chart right, a couple words about the mental side of trading. Trading can be mentally exhausting. You have to have the mental resolve to believe in your plan even when things aren't quite adding up, and to keep emotions in check from taking revenge trades, and the mental discipline to know when enough is enough. And that goes for profitable days and losing days. Very important. By far, the mental side of trading is the biggest piece of the puzzle that many traders struggle to grasp, and the whole reason that most traders never quite get a hold of or become successful traders. So again, I'm going to repeat this again because it is very important. Because if I was to design a course or education about trading, probably 50% of the course would have more to do with the mental side of trading. So again, you have to have the mental resolve to believe in your plan even when things aren't quite adding up, and to keep emotions in check from taking revenge trades. And revenge trades are things if you have it in your plan to go short, and somehow you get stopped out. And then moments later, after stopping out, and you see the slightest uptick and things are going, and you decide to flip and just abandon your plan and decide to go long. That's a revenge trade. And revenge trading is also, oh, I lost this amount, so I'm going to keep trading until I get this back. We all have to set rules and boundaries for ourselves to keep us mentally in check when it comes to trading. And a part of that is rules. When I'm a trader, or as I am a trader, one of the main rules that I look at trading, or how I look at trading, is that I look at things, especially in my futures trading, I look at things as if I'm a sniper. And I only have 3 bullets to make the kill. So that limits me to 3 trades. Wrong or right, after those 3 trades, I'm either switching to sim or I'm done for the day. So that's a part of that mental discipline, or the capital management side of trading. I know I said something in the video not too long ago that yes, you can make a lot of money in trading. However, the number 1 rule of trading is capital preservation, because your money is your number 1 tool. Without money, you can't trade. So we have to protect the capital through the bad days and the good days long enough for us to see that profit or successful days of trading. So that comes with it, that mental discipline of knowing when enough is enough. And like I said, that goes for good days and bad days, or profitable days and losing days. Because when I was starting out, I saw a lot of profitable days go red because I thought I could just do it forever or continue trading, and that I was just going to make so much money. And it doesn't necessarily work that way, because if you sit in front of the computer long enough, you'll give it back. And one of the things that I like to say, because I deal in a lot of probabilities, if you see when I release the pre-market outlook, I give probabilities on the 3 outlooks, or the outlooks which I favor the most, has the highest probability. And I like to say the only 100% probability in trading is that at some point you'll lose money. That's the only probability that I've ever seen that's 100%. All right, let's get to the chart. One of the most important principles to technical trading is convergence and divergence. You must understand what those are and how to apply it. Convergence is when price and indicator are moving in harmony. If price is trending up and the indicator is trending up, we're in convergence or confluence. Now, on the other hand, divergence is when price and indicator are not moving in harmony or are the opposite of each other. If price is trending up, the indicator is either trending down or moving lower. Being able to spot convergences and divergences is a must for technical traders. All right, getting into today's, let's go back and see what today's game plan was. All right. Bringing back today's game plan, we were on the lookout for a trend day down type of structure. And I explained it pre-market there. On open, we're looking for to open gap down, and that we would get a push back up towards yesterday close to try to fill the gap. But on our way back up, we should find resistance before, around or before we get to yesterday's close. And at that point, we would reverse trend toward the first target of 464. And then we had a secondary target of 461. We should get some midday chop, and at the end, a slight pullback. So, like I said, it's a twisted version of a trend day. And this is the diagram or the day map that was given pre-market. Push up, down, sideways chop, further down movement towards secondary target. All right. Now, here at the open, let me see if we can get some things on the chart to help us out. At the open, we see we got our up push to fill that gap. And we went right up to that point. We went up to see what the yesterday's closing price was. 467.38. We pretty much went right up to that point. And going up to that point, we can start to see the important principles of convergence and divergence at work. The first thing to pay attention to is the divergence of volume right off the opening. As price is moving up, what do we got on volume? Volume is moving down. That is a great or almost perfect example of divergence. Price is moving up, volume is moving down. So from this point, you know something is funny. Now, we get to the level where I said we would find resistance up here in the 467 area. Now, price is either doing one or two things. It's either trending or non-trending. Another way I like to say it is price is either in consolidation or expansion. Here we see consolidation. It's not trending up, it's not trending down. We're moving in a sideways motion. And if you understand the principles of momentum, this is the building or compression of that spring before we pow and just pop out and either start trending up or trending down. But that energy is built in this consolidation mode. And that's what we have right here, this consolidation. Now, while we're consolidating, let's take a closer look at the indicator, the MACD. Now, as price is consolidating, what is the MACD doing? It is actually diverging. And what else do we have right here? We have an actual great sign that things are about to change. Right here, we have a cross on the MACD, which definitely tells us momentum is changing. We had positive momentum here, and then we cross over to a negative momentum here, even though price is still consolidating. So this is a clue to get ready for a change. Now that we have a shift of momentum on the MACD, look at price. Price begins to shift, or I can't say really reverse, but we shift into a downtrend. From right here, we start that downtrend. And another key to look at on this downtrend is that we have expanding bear volume. If you look at the bars on the volume indicator, we start seeing a lot more red candles, which is bear volume. We see a lot more bear volume, and then what you also start to see is it starts building. More bear volume, stronger downtrend. And as we go down, you see the confluence of the MACD. Downtrend in price, momentum of the MACD going down as well. That is confluence. Now, as long as we are in this state of confluence, there is nothing that should change our mind about being short or taking advantage of the downtrend. Spotting reversals to someone that's new can be very hard. One of the reasons it's so hard is that most indicators are lagging, meaning they are backward looking, not forward seeing. And there are only a few indicators that are forward seeing. The two examples that I can point to on this chart are volume and price action. those are the only two indicators that are either present or forward looking. And what I mean by forward looking is that you can see here with bare volume or more red candles, it means a stronger downtrend. And as you can see, bare volume grows, we continue this downtrend. Now, again, the only couple of forward-looking or present indicators are volume and price action. And right here is our first clue of a pullback or a reversal. If you see here where bull volume all of a sudden is bigger or taller than bear volume, it's still a lot of volume, but at this point, bull volume overtakes bear volume. So that's a sign to come in the future that momentum is possibly about to change again. And now, if you can see, almost 4 or 5 bars later, we get a cross on the MACD, definitely letting us know that momentum is changing. And at this point, this is pretty much where I got out of most of my puts, my intraday puts today. All right, so that's pretty much the look back of the trading day and the breakdown in a nutshell. So even right here, you have to have the resolve, the mental resolve to stick to your plan. And for me, this is hard, especially right here, as long as we chopped in that area. With my background being in futures trading, in futures, if we linger at a level like this and I'm short, if I get short here and we continue to linger and linger and linger and I don't get a sign that it's moving in my direction, I'm scratching that trade before I lose money. So it takes a lot of patience to stay in a trade like this. But when you're using options, it's different. Your entries don't have to be as perfectly timed. So you're given a lot more patience to stay in positions. Now, let's go back and try to look at this in real, or look at this kind of like we were looking in real time. Before the open, you have your game plan. We should get a probable push open to fill the gap. Boom. Second candle, up. Volume. Notice on the second candle, price is going higher, volume is going lower. We already have a divergence. Third candle, even more of a divergence. Here we go. We continue with the divergence. Continue. Even we get a strong candle up, but volume is not picking up, or it's not in confluence. We continue up. Continue up. At this point, we've reached the level that's predetermined in our trading plan in that 467 area, and we begin to flatten out. Even though we're flattening out, there's no sign that this is our time to enter. Now, we get our first sign of possible entry. Right here, the MACD, when we get this darker bar on the histogram, that shows us that momentum is waning on the MACD. Plus, we have our first signs of bear volume. If you're bold, this is where you enter. Now, the funny thing about trading is that you can get confirmations. You can wait around to get all the confirmations to back up your trade. But if you wait too long for too many confirmations, you've missed half the trade. So this is where that mental resolve of having a plan and being able to stick to that plan, or knowing that I'm willing to risk this much, and I know that if it goes bad, my point of risk is that if it goes above the 467 area, then I should scratch the trade. I should jump out of it because the risk has gotten too great. As we continue, bam, here we go. It's starting. If you enter here, you're taking heat. The trade is now starting to go back against you. But we still have confirmation that this is the right trade because momentum is continuing to wane on the MACD. And here we go. As momentum continues to wane on the MACD, we finally get a lower low. It's proven that we're in consolidation, we're moving sideways, and we have our first lower low in the consolidation pattern. We got a positive candle next, but look at the MACD. Momentum is continuing to wind down. Again, another negative candle, more bear volume, and momentum continues to wane down. Boom. Again, momentum is continuing to wane down. Even though we're getting a strong bull candle, momentum is still winding down. We get another strong bear candle. Again, momentum is still continuing to wind down. And there's something to be said. I don't get too deep into candle patterns, but there's a lot to be said for using candlesticks and recognizing candle patterns. It's a very helpful tool for a lot of people. It's just not something that I do very much of. But candle patterns are very helpful when using candlesticks. And there are very few candlestick patterns that I actually use or recognize in my trading. Like I said, it's a helpful tool for a lot of people. It's just not something something that I use or I have a very strong knowledge of. Another part of trading is that things have to be comfortable for you, because you're making split-second decisions, so you have to be comfortable in your decision making. One of the things, I watch a lot of NFL football, and one of the things for a quarterback is that when you see certain signs, you practiced this and you have it predetermined that if you see two deep safeties, it is a formation that's suitable for you to do a running play, because numbers are with you. The probabilities are with you that you will have success in the running play. Same goes in trading. When you recognize certain things, the probabilities have to be with you. And when you see momentum waning, when you see more and more bear volume, this means that the probabilities are with you that we're more than likely going to come out trending down out of this consolidation. As we continue, we get more that momentum is waning, and we're almost at a cross that shows us guaranteed that momentum is changed, but not quite yet. Momentum continues to wane, even though we're getting positive candles. But if you notice, what do we have from here to here? Lower highs. And what is a trend? More specifically, a downtrend. It's lower highs and lower lows. That makes a trend. So now that we're getting lower highs, it's another confirmation that our plan is correct. As we continue on, we get the momentum cross. Momentum has officially changed at this point because we have the crossover on the MACD. Continue. Momentum is crossed. More confirmation that our plan is right. We need to stick to the plan. And like I said, even for me, when we start chopping at an area this long, and because of my futures background, it's hard for me to believe that this is going my way, because in futures, when you chop at a level this, futures move very fast. So when we continue to chop and chop and chop and wind down right here, it's hard for me to stay in the trade. And because of that, I only got half of my position on this morning, because it was just hard for me to believe it was, the plan is right. I should be here, but it's all about risk to me and capital preservation. So for that reason, because we didn't go within a certain number of bars, I was only able to get half of the position on. And as we continue, you'll see why, because we start going back up. Consecutive bull or positive candles, which got me to thinking that, you know, this could change and we could go on to that range day and continue up some more. But right here we have a pause candle, a doji in the candlestick world. That pretty much means pause. We're indecisive right now. Another doji, pause, indecisive. But we still have negative momentum. We still have bear volume coming. So I should stick with the trade. Continue on, and boom. Now we're starting to build some delta in here. And you can see we got a lower low, which means we're definitely in the right trade. And as we keep on, it still tries to go, it's fighting, and bam, there we go. We're making money. So those are the key things to being in the moment and successfully administering your trading plan. So that's the breakdown for today. And as always, understand and know your risk. Every entry should have a risk exit and a profit target. I hope this helps, and let me know what you think about the video. Be sure to leave your likes, comments, and please subscribe. Have a great night.